Hey guys, welcome to the channel. Today I'm going to talk about how leverage works, what's the benefits of using leverage, and what are the possible pitfalls of using leverage. So stick around and let's get into it. Before we get started, if you enjoy these videos and want to help us make more, please press the like button. Subscribe to our channel and press that bell for notifications so you know when we release new videos. Now let's get started. How leverage works. Leverage is the use of financing to borrow capital for an investment with the expectation that by multiplying the risk-reward relationship of the investment, you will create more profit. In other words, the more money you invest, the more risk you have, and the larger the rewards or profits you will receive if all goes well with that investment. The difference between using cash and leveraging or financing an investment, let's dive into that a little bit. Let's assume you have $100,000 to invest and you want to purchase a rental property. You find a rental property for the $100,000 and you decide to finance it by putting 20% down at 5% interest. If that property rents for $1,000 a month, it's making a 12% gross annual return. After you deduct the mortgage interest, you're making a net of 7%. That's still a pretty good return, and you didn't have to spend your full $100,000 to get it either. You only spent $20,000 out of pocket for the down payment, thus leaving you with $80,000 cash to invest in other properties. Assuming you could repeat the deals I just outlined for you, you could do that 5 times by taking the $20,000 as a down payment on 5 properties. That would use all of your $100,000, and it would give you a gross income of $60,000 per year and a net income of $35,000 a year after you'd paid the mortgage interest. If you paid cash for a property, you would have to spend all of your $100,000 and you would make 5% more because you don't have the mortgage. So this is where the leverage kind of kicks in. That's only $12,000 per year or a 12% return versus a $35,000 profit or a 35% return you would make if you bought 5 properties. Now mortgages are usually some of the cheapest money you can borrow because they are loans that are backed by the asset of real estate. Mortgage rates are currently at historically low rates. If you choose to finance, I would only finance properties with a fixed rate mortgage. The advantage of financing real estate with a fixed rate mortgage is the rate is locked in and cannot be raised for the term of the mortgage. Another great advantage is that you have the ability to refinance if the interest rates were to go down, or just keep the lower rate if the rate increases. So it's a win-win situation. Variable rate and interest-only mortgages might be available at slightly cheaper rates, but the risk of the rate increasing as the loan matures is much higher. For that reason, I would avoid these types of mortgages. Appreciation is another thing we should consider. Appreciation is a great wealth builder. And the more properties you own, the more wealth you can create. And in the previous example, if the real estate market appreciated at only 2% per year, in 5 years your portfolio would increase 10% in value. So if you paid cash for the 1 property, your appreciation would be $10,000. If you financed the 5 properties, you would have an increase of $50,000. This shows how leverage can quickly build and multiply your wealth. Here's an overly simplified example of how leverage can be used to buy rental properties. This example only uses a 5% interest rate and a simple $100 per month for expenses. It does not factor in everything such as taxes, insurance, vacancies, repairs, maintenance. It's really basic. If you did 1 finance deal versus 1 cash deal, here's how the numbers work out. So let's compare these deals. The purchase amount is the same. It's $100,000 whether you're cash or finance. But on the finance side, you can see we only put 20% down, which is $20,000 versus 100% down of the $100,000 on the cash deal.
Now in the finance deal we have interest, so we have an interest rate of 5%, a term of 20 years, and a monthly payment of $527.96. On the cash side we have nothing because it's already paid for. Now the income, expenses, and gross profit are all the same for both the finance and the cash property. We have $12,000 in income, $3,600 in expenses, $8,400 gross profit. Where we see a difference is in the mortgage. It's $6,335.52 in mortgage payments for the year on the finance deal versus $0 on the cash. So that leaves us with a net profit in the finance deal of $2,064.48 versus an $8,400 profit on the cash side. So obviously the cash deal gives us more real cash profit. But when we look at this deal on a cash-on-cash basis, we look at the finance deal as a little bit better because we get 10.3% back on our money versus 8.4% for the cash deal. A couple more things we could look at is appreciation and equity. If we say the appreciation rate is 2% per year, then we're going to gain $2,000 a year on this house because it's a $100,000 house. And at the end of the first year, we'll have $23,180 in equity on the finance deal and $102,000 in equity on the cash deal. So now let's look at this chart where we can see the 5 finance deals come into play. Now you see we used the $100,000 to buy one cash house, or we used $20,000 to buy one finance house. Well, if we take that deal and multiply it by 5, taking the 20,000 by 5 equals 100,000, using that same $100,000, we could buy $500,000 worth of houses. If we use the same interest rate of 5%, 20 years, and the monthly payments now all total up to $26,3982. Now our income is multiplied by 5, so 12 times 5 is $60,000 a year. Our expenses are multiplied by 5, which is $18,000 a year. And our gross profit is also multiplied by 5, which is now $42,000 per year. Our mortgage payments all total for the year are $31,677.60. That leaves us with a net profit of $10,322.40. Now, if you look at our cash-on-cash return, it's the same. It's 10.3%, whether we buy 5 or 1 on the finance deal. But look at the cash that we had coming in. We're over the $8,400. We've got $10,000 in spendable cash. And we also, if we look at the bottom, we've got $10,000 in appreciation. And we've now got more equity at $115,900 in equity. So we actually came out better than the cash deal because we multiplied the number of houses we could buy with the same $100,000.
Hey guys, if you haven't subscribed already, you're going to want to do that. I've got some big news and some exciting videos coming down the pike, and you're going to want to be part of it. I just did my biggest real estate deal ever. So if you want to find out what that deal is and how it came about, go ahead and subscribe, click the bell for notifications, and you're going to find out coming up soon. Now, cash flow is king. If you look at the chart and you compare the one cash deal versus the one financing deal, you will see that you have more cash flow with a cash deal versus the one finance property. But when you multiply that by 5 properties, your cash flow surpasses the single cash deal. If the real estate market is on the rise, then financing offers more potential for wealth building, and it gives you the benefits of appreciation, mortgage tax deductions, and depreciation on the properties. On the other hand, if the real estate market is uncertain or peaking, then I definitely would caution against becoming heavily leveraged in real estate. In this example, you have $100,000 starting out. What you'll see though, a lot of times is most people don't have the $100,000. So it's not a choice of do I buy one property or buy 5 properties. It's do I buy one property or finance one property. And in those situations, as you can see, it's going to be better on a one-on-one deal if you pay cash. But if you only have $20,000 to buy the one property, then you can't buy the cash property. So the only choice you have is to finance. And that's what happens most of the time, is people only have the $20,000 or the 20% down, and they can only buy the one property, and they have the one finance deal where they don't make as much money, and they don't do as well as someone who's paying cash. The benefits of using leverage: you can use the rental income to pay the mortgage payment. The property will most likely appreciate over time. You're building equity in the property every month with your principal pay down. And it offers quicker wealth building with the same amount of starting cash. There are some negative points to using leverage. One of them is that it has to be timed with the market. If the market's going up, leverage works really well because you have all that appreciation and your equity builds as the appreciation builds. But if you're in a stagnant or downtrending economy and the prices start dropping on you, it is possible that you can end up upside down in a property, and you could end up losing money or even losing your property because you get overextended on your financing. I limit my exposure to debt. I don't like a lot of debt. At most, I'm only going to have 1 or 2 properties in my portfolio that are ever going to be financed at one time. I just don't believe in having a lot of financing, and so not that it's not a good tool, it's just something I'm more comfortable having my things paid off. Now, a lot of people disagree with me, say it's much better to have the loans and all that. I can agree to disagree on that, but I don't mind using a little bit of financing. I just financed a deal last week that I closed. I put over 40% down on that property, and so I'll have a 0 interest owner finance deal, and I'll pay it off within 18 months. So that's kind of how I use financing. Very limited, very small amounts, and very sporadically. So other than that, everything else I own is paid for in rental properties. So I don't have to worry about having a lot of exposure to leverage or financing. Thanks for watching. If you enjoyed this video, please press the like button. And if you'd like to see more, subscribe to our channel. Don't forget to hit the bell for notifications so you know when we release new videos. And if you'd like more information on real estate investing, go to retirerichwithrealestate.com. Until next time, I'm Paul Price, teaching you how to retire rich with real estate.